Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. Verizon is definitely a stock that's trading in deep value territory, and the dividend yield of 7% is something that can sometimes be an alarm bell for investors. So, is this a dividend yield that has gotten too high and we should worry about the company paying long term? Or is this a great buying opportunity? That's what I want to dig into today by looking at Verizon's financials. My name is Travis William. Thank you for watching Rive Investing. Please subscribe here on YouTube for all my content. And I want to start on the balance sheet. The reason I want to start here is to show just how much debt Verizon has. That's really the thing to be concerned about with this company and how little cash it has. So there's not a lot of cushion margin for safety there. $2.6 billion in cash. They have a lot of receivables. So there's a lot of money flowing through Verizon's business on a day to day basis. But this isn't a company that's just sitting on a whole bunch of cash. But they do have a lot of debt, $140.7 billion in long term debt, and then almost $10 billion of debt maturing within 1 year. So, about $150 billion worth of debt. They've got to pay for that debt, the interest that goes along with it, and pay for the dividend. That's what I want to dig into. If we look at the statement of cash flows, you can see that the business is spitting off about $37 billion in cash a year. Now, management uses a big chunk of that to pay for capital expenditures. That was $23 billion last year. They've said that that's going to fall to somewhere around $17 billion in a year or two. So that number will likely come down. But there is a significant amount of money that's spent on investing activities. Whatever's left over can be used to pay down debt or pay the dividend. The dividend number is the one right here, $10.8 billion and growing slightly over time. So that's what we want to see Verizon be able to generate from operating activities minus capital expenditures. Right now, the company is really on kind of a razor's edge with that. And they're getting to the point where if cash flow from operations don't go up or capital expenditures don't come down pretty quickly, they're going to actually have to start issuing debt just to keep paying the dividend. The other thing that investors are going to have to think about is rising interest rates. As interest rates go up, when any company, Verizon included, has to refinance debt, they're going to likely see higher interest rates than they've had in the past. The couple of things I want to start with here, the debt maturing within 1 year, $9.8 billion. I talked about that before. That's going to be a very low interest debt. But over the next 5 years, there's $23.9 billion in debt coming due. That's going to have to be refinanced likely to a higher rate than as low as 0.75%. If you go out even further to 5 to 10 years, interest rates are as low as 1.5%. And I'll show some of these numbers here in just a second, but there's some wiggle room here for the next 5 years or so where Verizon doesn't have a ton of debt that is coming due, but eventually these bills do have to be paid. And the interest rate the company is paying, some of it, which is floating right here, is going to increase over time. So that interest expense is going to increase. And when you have $150 billion worth of debt, a 1 percentage point increase in that interest rate cost is $1.5 billion. That's a very significant impact on the company's cash flows. This page right here shows the schedule of outstanding debt, basically just the list of all of the debt that Verizon has. With a company this size, there's a ton of information here, so I'm not going to go through all of it, but I'm going to start right here with the near-term debt that is coming due. And some of this is denominated in euros, some of it is in Australian dollars. It's kind of all over the world. But you can see here the debt that's due on March 1st, 2024 has a coupon rate of 1.65%. The next debt due again, March 2024, 0.75%. The next one is a floating rate. The next three, which add up to nearly $3 billion in debt, is going to be under 4%. Here's another one, under 1%. This is all extremely low cost debt, and all of this debt is coming due within the next 2 years. It's likely that the refinancing cost is going to be at least 2 or 3 percentage points higher than what we've seen in the past. So the interest costs alone are going to be hundreds of millions of dollars more than they have been previously for Verizon. So that's something to keep an eye on. All right, so I've talked about the fact that there's very little wiggle room for Verizon to pay the current dividend, that costs are likely going to go up at least a little bit over time because of the high debt load. So, what does the business look like and what can we expect? Is there a significant increase in cash flow coming? We can start to get some indications here, but there are a lot of questions for Verizon, and the company's going to have to actually perform really well in 2023 and 2024. What I'm looking at is this total service revenue number. Verizon really has two pieces of revenue. One is wireless equipment, and the other is service revenue. Wireless equipment is something that typically loses money. So when Verizon sells you a new smartphone, they typically lose money on that deal. But they're willing to do that because the service revenue is actually really high margin. It's more like a software margin of 70, 80%. So that's really where you want to see the growth. 5.9% growth is pretty strong for Verizon, and that's going to translate to higher cash flow. If you look at guidance for the year, management is expecting wireless service revenue to grow 2.5 to 4.5%. If that results in an increase in free cash flow or operating cash flow of higher than that percentage growth rate, that's going to be a positive indicator for the company. So that's really what I'm keeping an eye on, is what does that service revenue growth look like? Because that's really where all of Verizon's cash flow comes from, is that piece of the business. So is Verizon's dividend safe? I would say for now, the answer is yes. But what we have to see is a significant increase in the company's operating cash flow and a reduction in capital expenditures to keep that dividend in place. And even if that happens, there's going to be significant increases in risk because of the debt that's on the balance sheet. I would actually like to see Verizon start to pay down some of that debt. They could likely buy some of that longer term debt at a discount, given the fact that interest rates are up. So that could be an attractive option. I also wouldn't be surprised to see all of the telecommunications companies in the US start to raise prices. They've all got debt loads, so they're going to have to generate more cash. We're starting to see a little bit of that from Verizon, but I think that's the one lever that they can really push. And then look at bundling and fixed wireless or 5G wireless that goes to the homes and businesses. Those two added revenue sources are going to be extremely high margin for Verizon because it doesn't take a big level of investment to grow into both of those areas. So those are the things that I'm going to be watching for Verizon. But I think this is a dividend that's going to be safe short term. But if it starts to creep up, it's really starting to tell you that investors are questioning whether the dividend is going to be safe long term, because this is such a highly leveraged business. But what do you think about Verizon and its dividend? I'd love to hear your thoughts in the comment section below. Don't forget to subscribe to Rive Investing. Thanks for watching, everybody. I'll see you here next time.